Hello everyone, welcome to the channel of Virtual Learning Hub. I am Devdeep Bhattacharya and today we will discuss about a very unique topic which is called leverage. If you are a student of commerce and you have an interest of learning, you may take a look on that topic. So let's focus on the topic. The term leverage refers to a relationship between two variables which are interrelated with reference to a business or a firm or an organization. The variable word is very important here. What does it mean? Variable as cost, output, sales revenue, EBIT, EBT, EPS. EBIT, EBT, EPS. We will understand about those words later. Now, what Van Horn says? He says leverage refers to the fixed cost in an attempt to increase profitability. He focused on the fixed cost. Now there is very little difference between what is fixed cost and what is operating fixed cost is. Here we will focus on the operating fixed cost. As I told, here cost means two type of cost: fixed operating cost and fixed financial cost. What is fixed operating cost is when you took too much asset and paying fixed cost on it. You are increasing your asset as you are increasing your cost. This is called operating fixed cost. And what is fixed financial cost is when a firm took fund from external source has to pay to return. What is external source is? There is three kind of source in a firm as equity, preference shareholder and debenture. Now equity owns by the firm and there is a huge difference between preference share and debenture. A little percentage have to pay by a firm on the behalf of debenture. It is a fixed percentage the firm has to be bear it, which is called fixed financial cost. As the debenture is higher, the risk is higher and of course the return will be higher, and the firm started to gaining profit. Now we have to understand this structure. This is the base of the chapter leverage. Suppose sales revenue in that amount. Let's deduct variable cost. And what is variable cost is? Variable cost is fixed per unit, but the cost is variable. And from sales revenue, we deduct variable cost, we'll get contribution. After deducting fixed cost from contribution, what we will get? This is called EBIT, earning before interest and tax. After deducting interest, we will get EBT, earning before tax. After deducting tax, this fund is available for equity shareholders. And suppose 1000 equity shareholders in a firm. What is earning per share? This fund of equity shareholder by this number of equity shareholder exist in a firm. Now, before understanding the classification, we need to understand what is the cost of return and the available balance of equity shareholders. Now, since cost of return has to be paid or incurred irrespectively of the volume of output or sales, the size of such cost or return has considerable influence over the amount of profits available for the equity shareholders. Yes, This is absolutely right. If the cost of return has to be paid or incurred irrespectively of the volume of output or sales, and the return is as per increasing, the profit is increasing, the fund is increasing for the equity shareholders. Now let's understand what is degree of operating leverage is. Now degree of operating leverage depends upon the amount of fixed element in the cost structure, which is mainly fixed cost in a firm, which is following the fixed cost in a firm of the cost structure. Now high degree of operating leverage means when a firm adopt a high amount of fixed cost, right? We'll discuss the numerical concept in the next part. Now, how to calculate DOL, degree of operating leverage? There is a formula called contribution by EBIT. Contribution by EBIT. This is called DOL for calculating. The amount we will get in contribution by the amount we will get after deducting fixed cost called EBIT. Now the DOL there is two kind of, it may be favorable or it may be unfavorable. And what is favorable? If the fixed cost is greater than contribution, which is called unfavorable. And what is favorable is if fixed cost less than contribution, which is called favorable. And there is another formula, what is degree of operating leverage? Is percentage change in EBIT by percentage change in sale. This is the opposite of this formula. Percentage change in EBIT by percentage change in sale. Now what is DFL? It indicates the changes that takes place in the taxable income as a result of change in EBIT. It is depending on EBIT and EBT, also EPS. Now, degree of financial leverage signifies the existence of fixed interest in the total capital structure of the company. Okay, and if debenture is higher than the equity shareholder, the leverage said to be bigger. And in case the debenture is smaller than equity, it will be much smaller. And how to calculate DFL? There is another formula, which is EBIT by EBT, as I marked. It's called TFL. And degree of financial leverage is percentage change in earning per share by percentage change in earning before interest and tax. Well, this I marked 2. This is also the opposite of the previous formula. There is also two kind of DFL, which is called favorable and unfavorable. Now what is favorable? The favorable means, which is very important, this word, trading on equity. Trading on equity, there is no sign of debenture, and if it is unfavorable and there is a existence of debenture. Now, if you merge DOL and DAFL, degree of operating leverage and degree of financial leverage, what you will get? You will get degree of combined leverage. If both of the leverage are combined, the result obtained will disclose the effect of change in sale over the change in taxable profit. Now, thus the combined leverage express the relationship between sales revenue and of course the taxable income. Okay, and what is combined leverage? Let's merge together. What is DFL? Contribution by EBIT into EBIT by EBT. This contribution by EBT, and let's merge these two. What you will get? Percentage change in EBIT by percentage change in sale and percentage change in EPS by percentage change in EBIT. What you will get? Percentage change in EPS by percentage change in sale. Okay. Now you have to understand what happens if the leverage is high. A high degree of leverage implies that there will be a large change in profits due to relatively small changes in sales and vice versa. Okay. Of course, if the high degree of leverage, there is a small changes in sales and profit. If the leverage is higher, if the leverage is high, then the fixed cost is high. This is the combination of DFL, DOL, DCL. If both of three are high in a firm, what happens? All of the leverage is high, fixed cost is high, we have to bear cost, the return we get high, the risk is high. Of course, the profitability will be high. Now, let's take a problem. In a firm called ABLTD, they have sales revenue 10 lakh, variable cost 7 lakh, fixed cost 2 lakh, is a debt 5 lakh. Is bearing 10% of fixed interest. Now calculate DOL, DFL and DCL, degree operating leverage, financial leverage and combined leverage. Okay. Now we're going to fix this problem on that particular structure as you will understand better. Now the sales revenue is 10 lakh, variable cost is 7 lakh, what we are getting, this is contribution as 3 lakh. Now let's deduct fixed cost. This is what we called EBIT. Now let's deduct the interest. 10% on 5 lakh, which is 50,000, is called EBT. Okay, and there is no such an amount, and there is no such amount of tax. Okay, now what is DOL? This is contribution by EBIT. What is 3 lakh by 1 lakh, which is 3. What is DFL? EBIT by EBT, 1 lakh by 50,000, which is 2. And what is DCL is? DOL into DFL, which is 3 into 2 equal to 6. Okay, right?